the line to get into the webinar, so I'm just going to wait for another minute before I start, and then we'll get stuck in. Just get as many people as we can online. Thanks. Okay, so I think everyone who's trying to get in is in. Apologies if you're still in the queue, but I think we should probably get started. So I decided to call this inaugural webinar for the year amidst all the chaos, risks to the market view of Fed policy. Expect nothing, prepared to be surprised. I guess my core view is that the surprises from the Fed are more likely to be to the upside for rates than to the downside, bearing in mind that the starting point now is that markets expect nothing at all. So the spread between the Fed funds future from this February to next February is now zero. Before the equity market really rolled over properly and the language from the Fed began to change fairly dramatically, it was pretty solidly pricing in 2 hikes, which of course is what the Fed still has in their own projections since the December meeting. So it's quite a big change, a positively dramatic change in a relatively short period of time. And of course, it traces back to the damage that was done by the stock market in the fourth quarter. The rollover was pretty dramatic. It started more or less immediately after the US announced the detailed list of 200 billion worth of Chinese imports that would be tariffed to 10%, possibly rising to 25. And then, of course, very soon after that, we saw China's retaliatory tariffs on US imports. And almost immediately after that, the market rolled over. I'm not suggesting that the tariffs were the only thing that did the damage, but I think they did quite a lot of the damage, alongside, I think, an increasing awareness that China's own domestic economy, the underlying domestic economy, aside from the tariff-affected bits, is slowing pretty sharply as well. So there's a lot of stuff swirling around there. But you can see from that first chart then that, after that pretty substantial collapse, about half of the losses have now been recovered. So equities are still some way off the peak, but nowhere near the bottom. And the fear, I think, that was very pervasive at the end of last year has diminished somewhat. Elsewhere in other financial conditions, credit spreads have risen a bit, but that wasn't really a story about a sudden spike at the end of last year. They did rise in the fourth quarter, but the upward trend began in mid-17. But looking at 10-year triple Bs against treasuries, at about 180 or so, that's not alarmingly tight by any stretch of the imagination. Obviously, it's nothing like what we saw in 2008, but it's nothing like we saw in the sort of the near recession of 2011. And it's still well below the peaks that we saw in early 2015, when we had a full-blown manufacturing recession and a 60% drop in capital spending in the oil business after the rollover in oil prices. So yeah, some deterioration in the market, but nothing to lose a lot of sleep over, I think, at this point. Looking at broad financial conditions, this is a Bloomberg index. There's 100 of these indexes out there, but the Bloomberg index has rebounded strongly. Obviously, the equity market is a big component of that. And as a result, now financial conditions are about as tight as they were early last spring, which wasn't catastrophic. And remember that after last spring, the Fed did then hike in June, September, and December. So it's very hard for me to look at these numbers and get really sort of deeply alarmed. You can be, I think, uncomfortable is a realistic position to take. Especially if you're bearish about the short-term outlook. If you think the government shutdown is going to last indefinitely, then things are really problematic. And I don't find it difficult at all to imagine zero growth in the first quarter if the shutdown lasts right through the quarter. And I see that Kevin Hassett at the CEA, effectively the voice of the White House, said yesterday that he believed growth could be zero in the first quarter. So thank you for agreeing with me, Kevin. That always makes me nervous when they agree with me. But it seems a reasonable view if the shutdown persists. I just don't know what's going to happen here. My assumption, let's call it an assumption rather than a forecast, is that the shutdown will be over at some point in the next couple of weeks, because I think the pain is becoming quite difficult to bear politically. The latest round of polling is dreadful for Trump. Big drops in his approval ratings, big jumps in his disapproval ratings. The pressure is becoming quite intense now. So I do think there'll be a deal to end the shutdown at some point. What form it will take, I really don't know, but I would be surprised if it lasted through the whole of the quarter. So there'll be a period of catch-up. There will be a net hit in Q1, but hopefully the disaster of a zero can be avoided. Of course, the longer it goes on, the more difficult it will be to recover the ground that gets lost. Obviously, federal government employees, both those essential workers working for nothing and those furloughed workers not working at all, are going to be paid back pay. So the cash flow will come back. But, if you're a business that depends on federal government workers and you go bust next month, then, the fact that those people then get their pay in March is not really very helpful to you. So there is an asterisk undoubtedly on the growth story for the first part of the year, and it will definitely be worse if the shutdown persists. But for what it's worth, my working assumption is it'll be over within the next couple of weeks. You may take a different view. Anyway. So I think the point of these first few charts is just to demonstrate that I don't think the sky's falling in. There was a period in the fourth quarter, certainly around Christmas, when things really did look very nasty. And it's not every day when I feel compelled to pull myself off the beach and write during vacations. But it was really messy in December, and it did require a response. So that hasn't continued. I mean, that's the key point, really. It hasn't continued. So I think at this point it's worth taking a step back, now that we don't have to be obsessed by every minute movement in the markets. Take a step back and have a look at where we are in terms of the current policy stance, and it's really not very tight. So this chart shows the cyclical turning points in the unemployment rate since the late 80s. So there's been really three big cyclical upturns in the unemployment rate, which is inverted. So here, for example, this is an increase in the unemployment rate, as it is here, and obviously the disaster of 2008-9. All of those increases in the unemployment rate, all of those cyclical turning points came after the real Fed funds rate was north of 2%. And actually, in the first two cases, it was well north of 3%. Now, is it carved in stone that the US unemployment rate cannot have a cyclical upturn if real rates are below 2%? No, not necessarily. Things change, economic structures change, balance sheets change, flows change. It's possible, but where we are now with real short rates, at just above zero, I'm going to go higher, but on most forecasts, not a lot higher. We're a million miles away from where you need to be in order to generate a cyclical shift in the unemployment rate. So my initial take on the policy stance then is that expectations that the Fed will do nothing more are really problematic, unless you believe the shutdown lasts forever and there's never a trade deal with China, and that various other things all go horribly wrong as well. I'm really struggling with the idea that the Fed is anything like tight enough to deal with the unemployment rate at 4% and still trending downwards. If you broaden the analysis as well to incorporate the impact of QE on the Fed stance, they look even more loose. So the blue line on the chart is the real Fed funds rate, just nominal Fed funds less core CPI, and the black line is the Fed funds rate allowing for the impact of QE. And I've used the analysis from the Swiss National Bank, which was published by the San Fran Fed. They reckon that 1% Fed funds equivalent of QE was 675 billion increase in bank reserves. Now, bank reserves rose by 2.7 trillion. So in other words, their analysis reckoned that that the QE was worth about 4% of the funds rate. So adding that in, the QE augmented real Fed funds rate is still minus 2.5. And of course, before 2008, there's no such thing as a QE augmented funds rate because there wasn't one. But the point is that looking at previous cyclical turns, if this analysis of the impact of QE is correct, and to emphasize, nobody knows because there's no history. But the point is that if you make any allowance for the impact of QE, if you look at the stock rather than the flow, then the Fed is even looser than they appear just by looking at rates alone. If you take the view that the flow of QE is the only thing that counts, then the fact that we're now into a QT environment means you're not going to agree with this analysis. But most of the analysis that I've seen, and certainly the view that the Fed has propagated in public over and over again, is that what matters is the stock of the Fed's balance sheet, not the flow. And the stock is still hugely overextended. So I'm pretty happy to argue that from this sort of big picture perspective, the Fed isn't tight enough, and that therefore expectations of them doing nothing are potentially risky. Another way of looking at it is to look at the impact of the Fed's policy stance on the private sector, because this is a developed economy. We're not going to have a recession or a cyclical downturn of any sort that's triggered by the government suddenly pulling in its belt. This is not a DM where recessions can be driven by the impact of market pressure on the private sector or the public sector or both. In developed economies, recessions are private sector phenomena. The exception, of course, is if you're a teeny country stuck in the Eurozone, but the US is not. So how do we look at the impact of Fed policy on the private sector? Well, we look at cash flows. So here we go. This is the Fed funds rate nominal on the left, and on the right is the debt service ratio for non-financial corporations. Now, first of all, let me just draw your attention to what happened in 2004. So here we get the turning point from the Fed early in 2004, and then in early 2006, exactly 2 years later, we get the turning point in debt service ratios, and they then track each other perfectly in parallel for the next couple of years until we get a peak just over 2%, at which point the economy falls over, and that falling over happened at not a very different rate from the previous cycle in 2001. So broadly speaking, history suggests you need to see that debt service ratio above 2%, in some cases well above 2%, in order to trigger a downturn, and that the lag between the actions of the Fed and rising debt service ratios is about 2 years, except that it's not. So the first rate hike in the cycle this time was 3 years ago, December 2015. And yet, as you can see, debt service ratios net are lower than they were at the point where the Fed made its first rate hike, and the recent trend is to the downside. So it's very hard, I think, to look at the state of corporate finances and argue with any conviction that the Fed is right now doing any damage. They're just not. Debt service ratios of 1.6% of GDP, a long, long way short of previous cyclical turning points, and still falling 3 years after the first rate hike. So how come the lag has changed? It's already half as long again as it was in 2006, and no sign of it turning. You might think that's kind of weird, because when you look at the corporate balance sheet, look at the stock of debt. So here we are. This is the 2007 at the turning point in our cycle, and here we are now. So we're above. There's more corporate debt now than there was at the time of the crash. The ratio is now about 133% of GDP, total business liabilities. Before the last recession in 2000, it was down at about 110. So there's a lot more corporate debt. There's a lot less household debt, but there's a lot more corporate debt. So you might think, well, in that case, how on earth have we not seen any upturn in debt service ratios? And the answer probably is because the debt is a lot longer. So chart 9, this is the blue line is the maturity in years of corporate debt at the point of issue. So the December number, the latest on the chart, was something of an outlier, but the trend, is let's see, about, apologies for the wobbly line, about 16 years. Whereas if you look back in the 04, 5, 6 period here, you're looking at something more like 8 or 9 years. So it's doubled. So corporate debt is much longer, and that means that the rollover, the crystallization of the Fed's actions is taking a lot longer to work through. So as far as corporates are concerned, the pain from rising interest rates simply isn't there yet, because they've all got so much longer debt, even though they've got more of it. The other line on the chart is the maturity at the point of issue of bank lending, C&I loans, and 700 days on the right-hand axis. And again, look back at the previous cycle, more like 450. Unfortunately, the Fed has discontinued these data, which is very annoying. So that's the last point we're ever going to see. But it's pretty clear that both small and large companies did what the Fed wanted them to do during the period of QE and zero rates, which is that they borrowed longer. But because they borrowed longer, the Fed's policies now, in terms of tightening, are not having the effect that they would normally have in the usual time frame. So, looking at this from the household perspective, again, Fed funds on the left, and on the right is the household debt service ratio. And again, you'll see no upturn. So the last time, in the last cycle, there's the turning point for the Fed funds rate, and the meaningful turning point for household debt ratios is about a year later. But again, they're still going down. The trend is still downwards slightly. There's been no impact. Remember as well that a lot of the debt back at the peak, and again, just to emphasize the point, just look at how much deleveraging there's been in the household sector. It's gone from about 135% of personal income to just over 100. That's a big, big deleveraging. And of course, remember at this time here, this peak, a lot of this debt is adjustable rate mortgages. And that's why when we go back and look again at the debt service ratios, which I've just overshot, that's why they rose quite quickly and hit a very high level, and why the household sector duly fell apart. But all those mortgages are gone now. Everyone has refinanced into 30-year fix. So the sensitivity isn't there. And of course, the level is so much lower. We're looking at about 9.7% of personal disposable income compared to more than 13% at the peak in 2007. So both households and corporates from a cash flow perspective are not feeling any pain from the Fed. To the extent that there's a threat then to the economy, well, there's the very well-known things like the ending of the tax cuts, but that's not really a threat. That's the absence of a positive, which we had for most of this year. And equally, the fall in gases, but that's another absence of a positive compared to Q4. But the really big deal, the big threat, of course, is external. So this is where the charts look rather less cheerful. So this is the PMI, China's PMI import component, leading slightly, and on the right is the ISM manufacturing index in the US. So this is a pretty distressing message. It's pretty clear that manufacturing is taking something of a pounding from China's slowdown, and how much of this we can blame on China's underlying slowdown and how much we can blame on the tariffs is debatable, but I would just make the point that this sudden rollover here, comes, at the time that the trade war is really hotting up. But there's no question China's underlying slowdown is a real and severe phenomenon as well. And so the outlook for US manufacturing is deteriorating. I'm expecting to see weak numbers on the production front, the orders front, and the capex front. At the moment, the orders numbers aren't being published. The durable good orders for December are due tomorrow, but we won't get them. But I think we can be pretty confident that the trend is deteriorating. In terms of output, it's a pretty messy picture. So last week's manufacturing production numbers for December were great, but remember, December was very warm, and it followed a very cold November, so there was bound to be a rebound. It leaves the production growth on the official data very elevated compared to the ISM. I've got to expect some downside risk for the next few months, bearing in mind that the ISM probably has got further to fall. So I'm really pretty bearish about manufacturing. It wouldn't surprise me in the least if the sector actually contracted over the first half of the year, so we get a recession in manufacturing. I think that's entirely reasonable. We're probably going to get real weakening in capital spending as well. Here's my favorite capex indicator 2 quarters ahead. It's the NFIB capex intentions. The December rollover doesn't really need any comment from me. I mean, you just need to look at it. It's horrible. But I suspect that we'll see something of a rebound. These ISM components tend to be quite sensitive to the stock market. And the December survey was conducted when the market was at its floor and when everything was in free fall and the volatility was at its peak. I'm not surprised that small business owners panicked somewhat. I think that number will rebound in January, February. It's not going to recover all the lost ground immediately, though. So I think it is reasonable to expect a slowdown in capital spending, partly in the manufacturing sector where it will be the most severe, and oil. But I'm not expecting anything as bad as the chart appears to suggest. But equally, after a year and a half when things began to recover quite nicely after the oil meltdown, there it is, it's disappointing to see things softening again. So a disappointment, I think I've chosen that word carefully, is very different to meltdown or rollover. And I think it's also important to remember that the US economy isn't a manufacturing economy anymore, and bad things can happen to manufacturing without it necessarily being very bad for the rest of the economy. That's certainly what happened, back in 2015 and 16, when manufacturing was actually in recession. Output fell across a 6-quarter period. It didn't fall in every quarter, but from the peak to the trough, there was 6 quarters, and it fell by a total of 2.5%, which isn't enormous, but nonetheless, manufacturing was in recession during that oil sector capex meltdown, and yet the rest of the economy wasn't. Payroll growth slowed a little bit, but it certainly didn't roll over. The unemployment rate kept falling. It simply didn't transmit. And the reason that it didn't transmit is that manufacturing really isn't a very big bit of the economy anymore. So, it's now 8.5% of payrolls, 12% of GDP. It's not contracting anymore as a share of GDP, or at least not very much. The big contractions was pretty much a straight line from 1960 through 2010. So, you might argue there was a little bit of a further deterioration around here when China joined the WTO, but essentially it just carried on a downward trend that had been in place for 30 years anyway. But the point is that it's very difficult for a sector which accounts for 8.5% of payrolls or 12% of GDP to cause a recession across the whole economy, especially when substantial bits of the rest of the economy are doing pretty well. What brings the manufacturing recession to an end, I think, is two things. First of all, to be clear, I am expecting a trade deal to be struck with China at some point over the next few months. So certainly by late spring, I expect a deal. The March 1st deadline, the 90 days since the Singapore dinner, that's probably asking too much, certainly in terms of details, because trade deals are at 2 stages. There's agreeing the principles, and then there's the legalese. But my take on this is that both sides desperately need a deal. It's playing very badly in China's manufacturing sector, as we can see. It's hurting the agricultural sector as well. It's hurting US farms really badly. Wisconsin has lost 8% of its farms over the last year. That's more than 700 farms have gone bust in one state, a state which, by the way, won the election for Trump in 2016. This is not sustainable. This is a disaster. US farmers are getting very worried that the soybean business they've lost to Brazil and elsewhere is gone for good, and because of China's tariffs. And things are really becoming very difficult. Plus, of course, manufacturing, we all know, supply chains are being disrupted, input prices have gone up, margins are being compressed. It's horrible. And the stock market hates it as well. Plus, Trump's approval ratings. I think he wants a deal. I think he wants a deal very badly. Right now, he's focused on the shutdown. And in the trade negotiations, it's Lighthizer playing bad cop and Trump tweeting good cop. But my suspicion is that once the shutdown is out of the way, his attention will swing back to the trade talks, and I think he wants a deal. And I think it's pretty easy to see where a deal can be done as well, because Xi Jinping wants a deal as well. And the common ground, I think, where they can both claim a big win is on this intellectual property and forced tech transfers and forced joint venture things that China knows are outrageous. They know they've been getting away with it for a very long time, and they know they can't get away with it forever. So how do they get out of it gracefully? Well, Xi Jinping goes back to the Chinese populace and says, look, our technology is now so great, our businesses are so strong that we don't need to steal stuff from the perfidious Americans. So, we've done a deal with them. And Trump gets to come back and say, look, I've made them stop stealing our IP. Both sides get to report it as a win to their domestic audiences, to their own base, and the tariffs get rolled back, and we get a big risk-on swing in markets globally, not just in the US and China. A big part of the German slowdown is because German exports to China have dropped by 8% over the last year. And I think this swings things around in the manufacturing sector really pretty quickly. So again, you may take issue with that view. I could be wrong. I could certainly be wrong about that. But you have to have a view, and at least that gives you a benchmark to think about. By the way, I should have said at the beginning, if you want to ask questions, please feel free to type away, and then I'll come back to them at the end. Anyway. So the other thing that's happening on the China front as well is domestic policy stimulus. It's not just a question of waiting for a deal on the trade side. The authorities are also stimulating. So our take on this is that the fruits of this ought to be visible in the second half of the year. So M1, Chinese M1, especially in dollar terms, is a really powerful indicator of Chinese import growth. And you can see there on this chart. So the blue line is M1 growth fitted from movements in sovereign yields, so just a simple M1 model. in dollar terms, China's M1 in US dollar terms. And the black line is the actual M1 in dollar terms. So you can see the model works really pretty well. And projecting the model forward suggests that we'll see a fairly abrupt turnaround pretty much now. That tends to lead Chinese import demand by about 6 months. So we're looking at a real clear upswing in Chinese import demand in the early part of the second half. So we've got to get through a tough patch first. And again, it comes back to my view that the US manufacturing sector will be in recession through the first half of the year. But it won't be endless. If anything, the danger is that China overstimulates. That's another story. But the key point here is that we are looking for a turn in Chinese import demand around the middle of the year, and that will feed through into global PMIs very quickly. They have to fall further first, but the fall is not going to last, I think, forever. And meanwhile, the background here in the domestic consumer sector, which I haven't really talked about, is really very different. The bad stuff just isn't happening there. So first of all, in the absence of the official retail sales numbers, which are affected by the shutdown, we do have pretty reliable, very useful real-time data on chain store sales from the Redbook. And these numbers are really kind of amazing. So we saw a pickup, after the tax cut started to work through, and then kind of carried on until the summer. Then we saw a leveling off, and then we saw chain store sales growth rocketing in the fourth quarter. Why was that? That was the drop in gas prices. The drop in gas prices was timed just perfectly if you were a retailer worrying about the holiday season. And as a result, we saw some really spectacular chain store sales numbers. The peak here, 9.3% in the week of Christmas, as a record, at least as far back as I've got data, which goes back to the mid-1990s. And that's astonishing when you think about it, bearing in mind these are chain store sales, so they're kind of dominated by clothing. Clothing prices are flat or falling. And these are physical stores. These are not, there's no internet stuff in here. This is physical stores. So against that backdrop, to get even 1 week of 9% year-over-year growth in physical chain store sales is pretty remarkable. The trend to which we've now been reverted is about 7%, and that'll probably subside a bit further in Q1 because the kick from gas prices will diminish. But nonetheless, if that trend runs at 5 or 6%, that really is a pretty healthy environment for retailers. And I think it's indicative of the fact that consumers' confidence is very robust. It has fallen since the stock market tanked, but it's still very high, and cash flow is really quite strong. But it's not just small ticket items like chain store sales. I mean, if you look at auto sales as well, these have been very noisy since Hurricane Harvey. There was a big spike after the hurricane, then it kind of mean reverted back to where it was before the hurricane. And so when we got down to this point here, late last summer, I kind of thought, well, we're just going to hang around here. But instead, we've had 4 great months for auto sales. So it's not just small ticket items. That drop in gas prices and elevated consumer confidence has kicked sales up really very nicely. 1 month is a fluke, but 4 is pretty hard to ignore. I doubt it can continue because, again, the incremental benefit from lower gas prices is over now, and they've actually started to nudge back up a little bit. Plus, of course, the benefit from the tax cuts is gone, and confidence has taken something of a hit, and wealth has taken something of a hit from the stock market. But these numbers aren't going to roll over. This is really still a very favorable position. The one thing on the consumer side that looks terrible is the housing market, which I need to address head on because I just don't buy the narrative, which is that everything just stinks and that the housing market rollover, if it is that, is a harbinger of terrible things to come in the rest of the economy. I will certainly admit that these numbers are just dreadful. That's new home sales and existing home sales. New home sales aren't being published now because of the shutdown, but the last number that we have for November was just dreadful. So actually it was October. This just looks absolutely awful, and it's very easy to just carry on and extrapolate, and suddenly you're in real rollover territory, and this makes people very nervous. But let's have a look at these numbers in context, and the context is to think about is how do they compare to the mortgage applications data, because ultimately that's the leading indicator. Most people buy a house with a mortgage, and the story here is quite different. So what we've got, the blue line is mortgage applications on the left. This is the MBA's Purchase Applications Index, which comes out on a Wednesday. Their data are seasonally adjusted, but I cannot stress enough that their seasonals are utter garbage. If there's anyone from the MBA listening, your seasonals are utter garbage. Readjusting them, the series is much smoother and much more sensible. And what it shows is that after a period of weakening in the first half of the year when mortgage rates were rising, We saw a rebound beginning in late summer, which has continued, and the latest numbers for the first 2 weeks of January are really spectacularly strong. The new home sales figures undershot in October. That's the most recent point. But October was the month of Hurricane Michael. The suggestion from the chart is if we were to get a November number, which again didn't happen because of the shutdown, it would have been up here somewhere, around the 600 mark. But because of the November was a very cold month, and the wildfires in California, that probably kept it down a little bit. The December number, though, December was warm. There was no wildfires, no hurricanes. It should have rebounded back to where the mortgage applications numbers suggest, 650-ish. And then, looking over the next few months, it should go up. So, I'm expecting to see a very, very clear rebound in home sales over the next few months. I don't buy the idea that the sky is falling in on the housing market. I think that the combination of Hurricane Florence, Hurricane Michael, the wildfires, cold November, stock market chaos, all these things were really bad for the market in Q4, but they're gone. So I'm not jumping on this housing as a disaster bandwagon. I've long taken the view that the market has more or less peaked for this cycle, but that's not the same as saying that it's going to roll over immediately. And I think the next surprise from housing is going to be to the upside, and it's going to come at the same time that we get these terrible manufacturing numbers. So it's going to look like a real sort of dichotomy. But remember, housing and all the other consumer stuff is more than 70% of GDP, and manufacturing is 12%. Markets overweight the importance of manufacturing, and so does the Fed. And that worries me because when things revert back to normal, we're going to have a very different picture than I think markets want to paint for themselves. Partly in the labor market. So my composite hiring index has weakened a little bit. That's the ISMs have pulled it down, but it's still pretty strong. And although actual payrolls, so here's the trend in the hiring index, and actual payrolls have been below it for a while. That's probably because companies can't find all the people they want to hire. So if that continues, we'll be printing high 100s for the next couple of months. And after a 312, whatever it was, private sector payroll number for December, I don't mind if we revert back to 175 or even 150 for January. But beyond that, those high 100s I think will continue. I don't really see any evidence of sustained weakening. If that happens, then the unemployment rate probably will keep falling. I know labour participation has picked up in the last few months. There we go. But look, pick up. None of them have been sustained. So I am not yet going to start extrapolating this latest pickup in participation and assume that it's going to continue. It might, but you could have made that argument any time in the last 5 years and you would have been wrong every time. So my assumption is that the participation will level off at something like the current level. In each case, with payrolls at approaching 200,000 a month, then the unemployment rate will keep falling. And ultimately, this is the constraint on the Fed. The short-term constraint on the Fed, I'm very willing to accept, is the uncertainty triggered by the drop in the stock market. It's the uncertainty triggered by the government shutdown and the trade war with China. I'm very happy with the idea that all of these things mean that they should and that they will take a breather in March. But by the time the middle of the year comes around, and I think we see clear signs that we're reverting back to something like growth sustained in the low twos, that ought to be enough to get the Fed back on alert. Bear in mind, the drop in unemployment from 10% to 4% was achieved with average GDP growth of 2.2%. So when people tell me that a slowdown in GDP growth from last year's 3% to something less than that means that the labour market stops tightening, I really have a problem with that, because that's not been the experience of the last few years. This year, could be different. It's possible that participation could rise strongly. It's possible productivity growth could pick up strongly. But I'm not willing to bet on those things being enough to prevent unemployment continuing to decline. And unemployment's already too low for any sort of conventional model of wages. The NFIB's jobs hard to fill number for December, despite the fourth quarter rollover in the stock market, hit a new all-time high. And you can see that wage growth, which was kind of flat in 15-16, has risen quite strongly. So year over year now is 3.2. A year ago it was 2.5. And I think that gap on the chart is going to continue to close, because I think we've finally got to the stage in the cycle where people appreciate that they have power in the labour force and the ability to exert some of that power in terms of extracting bigger raises. And you can see that in the fact that the number of strike days is rising. I don't know if you've seen this week, but teachers in LA were on strike for almost a week, and they've extracted a 6% raise from their employers as a result. Now they're going back to work. When the labor market's very tight, strikes can work, and people are starting to recognize that. So I think after an extended period where employers have really had it pretty easy, they're going to find it much more difficult. They can't find the people they want to hire. They're scared of letting people go. And their existing workforces are beginning to exert a degree of power and seeking bigger raises. If that happens, at the same time that we get softer capital spending this year, as I mentioned earlier, then two important developments follow. First, productivity growth doesn't pick up any further. It picked up last year. There's no question it picked up. It's probably going to average 1.5% for the year. But the delta for 2019 probably will be about zero. So no further pickup in productivity growth, but there will be a substantial positive delta in wage growth, which I think by the summer will be 3.5 plus, and by the end of the year will be approaching 4%. If that happens, the rate of growth of unit labor costs will turn up. And right now, that's very, very unthreatening, because unit labor costs, here's the chart, 4-quarter moving averages, because everything's so noisy. There is no threat in the unit labor cost figures right now, none at all. So Jay Powell has said a couple of times that he doesn't think that there's a strong correlation between wage growth and future inflation. Well, either he's not familiar with this chart or he was picking his words very carefully, because there is a very strong correlation between unit labor costs and future inflation, not necessarily between wages and future inflation, because it depends what's happening to productivity. But as I said, I think productivity growth has probably about peaked now. The next big delta in the unit labor cost calculation is going to be in the nominal growth rate of hourly earnings, and we could end up with unit labor costs hopping up to somewhere like this over the course of the next year. That's not an inflation disaster, but it is something that the Fed would want to dampen, and that requires policy action. It's also, I think, worth bearing in mind here that businesses are starting to talk increasingly about pricing power as well, or passing on increased labor costs anyway. And one of the things I'm watching pretty closely, I'd urge you to track, is the NFIB selling price index. I tend not to look at it as it's published because it's quite sensitive to gas prices in the short term, so I have to strip out the gas price effect. And when you do that, you'll see that it's risen really quite relentlessly over the course of the last year, apart from a little dip in the spring. And it's now consistent with core CPI inflation rising to about 2.6%. It's not always a perfect indicator, but it does tend to catch the turning points about a year in advance, and that makes it valuable. And so I think that the message here, both from my labor market view and looking at what businesses are saying, is that cost pressures and pricing pressures are building. Now, some of this might be tariff related, it's impossible to say, but remember that most NFIB companies aren't engaging in international trade of any sort. Most of them are in the services sector. So this is a potentially very significant development. I would urge you to keep an eye on it. And what I think happens here is that the Fed gets dragged back towards these labor market and cost and price considerations around the middle of the year. Once the trade deal is done, the shutdown's over, China's stimulus is working, and we start to see a rebound in these indicators. So right now their attention is elsewhere, but it's going to come back. And I think what we've learned over the last few months is that this is a very data-sensitive Fed. I know the phrase they use is data-dependent, but I kind of think that's not strong enough. We went from Powell saying, in late October that things were, quote, remarkably positive, and here we are a couple of months later, and it's all about headwinds and patience and slowdown and risk and all the rest of it. That's been quite a dramatic turnaround, triggered by a drop in the stock market, half of which is reverse, and some weakening in some economic indicators, some of which, like housing, I'm not taking at all seriously. So I think that the danger here is that markets are now expecting nothing, but the Fed could swing around on a dime once it becomes clear that the things that have scared them are no longer very scary. As I said, that's not imminent. But by the middle of the year, I think the chance of the Fed having to refocus on these labor market indicators, which ultimately is the constraint on them, is really very real. And what they want to avoid ultimately, and what I think is going to mean that they eventually want a slowdown, what they want to avoid is this. So this is the Phillips curve, unemployment rate on the x-axis and average hourly earnings growth on the y-axis. So the data here go from 55 to 69, and then from 1985 onwards, because from 1970 to 84, we had the period of chaotic inflation, including the two oil shocks, the fallout from the Vietnam War, Nixon's wage and price controls, you name it, every policy mistake imaginable, plus exogenous effects, it shreds the data. When you take those data out, you get a nice looking Phillips curve. Here's the latest point. We're off the Phillips curve now. So here's the danger. If the unemployment rate keeps falling and people exert their power in the labor market, what is to stop that point on the Phillips curve moving higher? Unemployment falling, wages accelerating. I'm not forecasting as a base case that wage growth is going to get to 5%, but to argue that it can't get to 5%, that's risky. That's very risky. And I promise you, if it gets anywhere near 5%, the Fed will be in full-on panic mode. And if you look at their behavior over the last 30 years, wage growth of 4% tends to be where they put the brakes on hard. Now, we're at 3.2, but we could get to 4% in a heartbeat if people really are about to start exerting the power that they're now developing in the labor market. So I'm going to wrap up shortly, but I just want to kind of emphasize the base case here. So I'm very happy to accept the growth is slowing, the tax cut effect is fading, the gas price effect is going to fade, manufacturing is suffering from the slowdown, shutdown isn't helping either, and the trade war. I mean, it's something of a mess in the first few months of the year. But lift up your eyes and look to the horizon, not to the ground. There is going to be a trade deal because China and the US both need one really very badly. It's hurting in places where Trump needs not to be hurting when he's thinking about 2020. And it's hurting the market, which he views as being an arbiter of his performance. It's hurting in China as well. Both sides need a deal. China's stimulating its economy anyway. And when that stimulus comes through and the trade deal is done, think about the domestic fundamentals. In the meantime, right now, patience, absolutely, the Fed isn't going to do anything. But they're sensitive to the data. And I think the point here is that the fading of the downside risks, the easing of the headwinds, and possibly from China a reversal of the headwinds, means that when they say they're going to hike a couple of times this year, I think they're being realistic, and I think markets are not being realistic and expecting absolutely nothing from them. Pricing in zero, I think, is very dangerous. So I'm expecting to hike at least twice, starting in June. And if wage growth really takes off, then all bets are off. The Fed will hike aggressively, and there'll be a recession in 2020. The saving grace is it won't be very bad because the imbalances in the corporate sector and the household sector are very small. In fact, they're both at the moment net savers, and it's very difficult to get a deep recession if your private sector is a net saver already. But the road, I think, is not as smooth as markets want to believe. I think people have been blindsided by some of the housing data, which I think are being blown out of all proportion, both in terms of how bad it is, how bad it's going to be, and its importance for the rest of the economy. And the same argument applies to manufacturing, which genuinely is in trouble, but equally genuinely isn't a very big share of GDP. Focus, I think, on the services sector, focus on the underlying strength of private demand, focus on the labor market, because when the dust settles and we're clear of the chaos, that's what the Fed will be focusing on. So I will leave it there. Very happy to answer any questions that you might have, things that I haven't mentioned, things you agree with, disagree with, or you'd like me to expand on, because I realize I've rattled through quite a lot of material in a fairly short space of time. So I will wait for a minute or so for any questions. If there aren't any, we will say goodbye, but please feel free to tap away. So a question here on the corporate debt story I was talking about earlier. Longer dated corporate debt lowers rollover risk, but surely it means a greater negative wealth effect when a big rise in spreads occurs. It's held in ETF form. So bank financial system risk is low, but wealth effects are greater. Well, wealth effects are greater because there's an awful lot more debt around. So yeah, I mean, a given percentage decline, if you like, in the value of the stock of corporate debt imposes a significantly bigger wealth hit than in the past. So yeah, that's true. The implications for the household sector, anyway, at least I think, are quite limited from there. I can find basically zero correlation between movements in corporate bonds and consumer confidence, but obviously, imposing substantial losses on investors is a net negative. It's a tightening of financial conditions. It's nothing to be welcomed. I'm just not sure it's a huge deal at the moment. You repeatedly said consumer spending growth is not sustainable. What should we expect in 2019 and 20? So consumer spending growth is not sustainable because the tax cuts won't be repeated, and the drop in gas prices won't be repeated either. So I think we should probably expect the rate of growth of consumer spending this year to revert back to the rate of growth of real incomes after tax, which is going to be in the 2 to 2.5 range. So we've had some very nice 3+ numbers for consumer spending. Probably had another one in the fourth quarter, but I think the trend is more like 2.25, 2.5. That's not bad, but it's it's a significant part of the slowdown story. The growth going back from 3 to 2 and a bit. And again, I don't think it's a disaster, but we have to be prepared for the fact that the tax cut fueled surge in spending is just not sustainable. What's your view on the effect of rate hikes on the housing market? How long do you anticipate the lag between rate hikes and household debt service increases will be? That's a good question. What now is the lag between Fed rate hikes and turning points in debt service ratios? And this applies to corporates as well as to housing. And the answer is, I don't know. I just simply have not managed to model it successfully because there's no history that looks anything like this. And there's also very little data, certainly on a consistent time series basis, which allows you to estimate with any confidence at all what the average maturity is of the outstanding stock of debt. As I showed you, we do have data on the flow, the maturity of the flow of new corporate bond issuance, but we no longer have data on the flow of new bank debt, and we don't have a lot of detailed information on either the stock or the flow for the household side. So this is really a problem, and what it means is that I've tried endlessly to model this, but I just can't get it to work very effectively, and therefore I don't really have any confidence in it. All I can say is sooner or later the rate hikes will have to work through, but equally, as of right now, there's just no evidence of it at all. So I'm watching it very closely. The data are quarterly, but as of now, there's just no sign of a turn. Rate hikes on the housing market. Well, the effect on the housing market depends on the transmission from the funds rate to mortgage rates, and that's not necessarily mechanical. I'm pretty sure that the 40 basis point drop in mortgage rates since November has helped to push applications up, and if that reverses, they'll go back down to where they were before. But again, where they were before wasn't bad. It was just the market going sideways. So we're going to need to see a pretty substantial rise in yields. With the 10-year Treasury, getting north of 3.25 before I would turn meaningfully outright bearish on housing. And as of right now, I think the outlook for the next few months is positive. Ultimately, housing depends on where rates go, but we're a long way from the sort of rates that I think would be a real dampener. What do you see the impact from the upcoming elections? I'm assuming that's a reference to 2020, which thankfully is still some way off. I think the key implication of it is likely to come in budget negotiations. So I'm not expecting any more tax cuts because they can't get through the House, the Democrat House. But spending increases are a different matter. And although right now, we do face at the end of this year something of a fiscal cliffet when the spending increases that were agreed last March run out. But I think it's quite likely that they will be re-upped. For the same reason that spending was increased in March 2018, which is that the Democrats want more spending on non-defense, on social programs, and the Republicans want more spending on defense, and so they give each other what they want, and aggregate spending goes up. There's not a single adult left in Congress when it comes to public spending, and even the ones who claim to be people like Paul Ryan turned out to be charlatans. There's nobody left who appears to think there's any connection at all between fiscal policy and the price that has to be paid either by this generation or the next one. As a result, I don't think they'll have any qualms at all about raising spending again. So I think that with the election coming, I think both sides want to give something to their constituency. I mean that in the broadest sense. And so, yeah, I'm expecting another increase in spending to prevent the fiscal cliffet in 2020. But I'm not expecting an infrastructure bill, and I'm not expecting any more tax cuts. How exposed is the US to risks from a worst-case Brexit scenario? Well, not massively, but it would be an enormously disruptive event for the whole of Europe, and there would be some blowback into the US. I mean, the US is a big trading partner for the UK, but the UK is not a very big trading partner for the US. There would be a hit because the British economy would contract, and US exports would find life difficult because cable probably would drop to, I don't know, 110, maybe even lower. So there'd be an immediate pricing shock, and there'd be a demand shock as well. It would be bad, but I also think it's not very likely. Our base case for a very, very long time has been that no deal will not happen, and that eventually, when everyone's staring over the abyss, there will be some sort of deal. So I think it's probably more likely that in 3-6 months' time, cable's at 140 rather than 110. But if it happens, it's bad. Another question: 2020 recession only if the Fed kills the cycle, pressured by wages, with manufacturing and technical recession in 19. Any other domestic threat in the service sector that could bring forward the next downturn? Not on the immediate horizon. I mean, the scenario where that would happen, I think, would be, if that pricing pressure that the NFIB survey is talking about comes through in full, and especially if it comes through more quickly than the survey suggests, then the Fed has to act aggressively and it has to signal further aggressive actions. We then get a big rise in yields across the curve. Housing tanks, consumer confidence rolls over, the auto market falls apart. Yeah, I mean, that's how you get it. But I got to say, that requires a lot of things to happen, and I don't really see much sign of it. The alternative scenario that brings that about is the nightmare scenario. Well, the real nightmare scenario has two phases. First of all, the shutdown goes on endlessly, and that would be really, really bad. And secondly, we don't get a trade deal with China. Now, I realize that's not purely a domestic threat, but it would have profound domestic implications, because if the talks with China fall apart and the US imposes tariffs on consumer goods, as it's threatening to do, that's a disaster, because that's a massive real income hit to consumers. It drives up core inflation overnight. It drives down growth. The Fed is stuck like a rabbit in the headlights, wondering which one to deal with. Consumers are miserable. We've seen, if you look at the CPI laundry equipment component, which you can do on Bloomberg, the year-over-year rate before tariffs were imposed on washing machines from Samsung and LG was running at about -5%. Now it's a +15%. So let's not kid ourselves here. Tariffs on consumer goods are a total disaster. I don't think the US wants to impose them or is going to impose them, but in the worst case scenario, so what you asked about, then yeah, absolutely, that's a nightmare, and then all bets are off. Absolutely. Anyway, I think that's the last question. I've taken a lot of your time, so thank you very much for sticking with me. Obviously, anything that I haven't got to, or things that you want to follow up with later, please feel free to shoot me an email. I will be available, and I'm happy to answer any questions, anything that comes to you afterwards. But thanks very much for your time, very much appreciated, and look forward to next time. Thanks very much.